Hello and welcome to Sloss Investor. Hello and welcome to Sloss Investor, the channel where we believe in growing wealth slowly but surely. Today, we are doing something a little bit different. I'm gonna take you through my personal stock portfolio. I believe this is a great way for us to learn and grow together. So if you are new here, remember to hit that subscribe button. And without further ado, let's dive in. Last time, we talked about Alphabet's quarterly report and how to read it. Alphabet, the parent company of Google, is the world's biggest advertising player. It controls 90% of the search traffic. We want to own monopolies, and Google is definitely one. They have 4.3 billion users. Just imagine that, 4.3 billion. That's half the world's population. That's impressive. You saw that without me buying any more Alphabet shares, my ownership in the company increased over the past 3 months from 1 in 84.6 million to 1 in 84 million because of their share buyback. They lowered their number of shares by 88 million. Plus, their trailing 12 months free cash flow grew from 62 to 71 billion, increasing my income from Google by 16% in just 3 months. That's fantastic growth. Next, we will move on to Apple, which is my favorite company in the world. I've worked with Apple platform for 15 years as a software engineer, so I know them pretty well. They have a whopping 2 billion active and loyal users, which are more like fans than users, with 1.5 billion active iPhones and selling 200 million new ones yearly. People might say iPhone sales are maxed out,
But I disagree.
customers buy over 1 billion smartphones each year. So there is room for growth with 20% of the new market. As long as they keep making quality products and expand into markets like China and India, those numbers will rise. And remember, the iPhone is just one part of their business. Besides all the hardwares, they also have a growing service segment with higher margins than products. A few years ago, services were 11% of their revenue, and now it's 20%. I believe this will keep growing as they introduce more services to their 2 billion users. Checking their latest reports, 3 months ago Apple had 15.7 billion shares and now it's 15.6 billion. So without buying new shares, my ownership increased from 1 in 98.3 million to 1 in 97.7 million. Their trailing 12 months free cash flow went from 97.5 to 101 billion, boosting my income from Apple by 4% in 3 months. Next, we have Microsoft. They own Microsoft Windows, Teams, Office, Azure, Xbox, LinkedIn, and much more. They create a strong network effect between their products to boost sales. If you use Microsoft Office in your work, you are more likely to use Microsoft Cloud since it works seamlessly with your current service. Now let's take a look at their latest report and see how it has affected our portfolio. 3 months ago, they had 7,435 million shares, and now they have 7,429 million. Microsoft spends low amount of their free cash flow on share buybacks compared to Apple, so no big changes there. But hey, each small step forward counts. Their trailing 12 months free cash flow grew from 57.4 to 59.5 billion in the past 3 months, increasing my income from Microsoft by 3.5% without me buying new shares. Hopefully the price will drop soon and we can add more shares to our portfolio. Next company on our portfolio is Intel. They have a narrow moat compared to other companies here, but they are still the market share leader in CPU for PCs and servers. This is a different type of investment. They faced challenges recently, but they are turning things around. They are investing heavily into new factories, trying to gain their lost market share, and at the same time, cyclicality of the market hit them pretty bad too, which caused their revenue to drop significantly. But I believe the new CEO is doing a great job of turning the ship around, and hopefully in a couple of years, they they will be back to their previous leading position. Over the past 3 months, their shares went from 4.17 to 4.19 billion. They are not spending any money on share buybacks right now. Management needs to decide what brings a better return to invested capital, and they believe reinvesting back into the business makes more sense right now than giving back to the shareholders through share buybacks. Their trailing 12 months free cash flow improved by 17% over the past 3 months, from negative 20 to negative 16.5 billion. So it's moving in the right direction, but it's still a long way from where we want it to be. Hopefully in a couple of years, their turnaround plans will start showing better results and they will once again reach their glory days. Next, we have Amazon, the top online retailer in the world with a growing cloud presence and advertising business. The fourth biggest player in the world and gaining market share very fast. They too have had negative free cash flow in the recent years, which was caused by lower cash from operation and higher capital expenditures. They had a big jump in 2020 with people stuck at home, and now we see a reversion to the mean. But comparing to 2019, we can see they are still growing very fast. Hopefully when their investment in the past 2 years start creating more cash, their free cash flow will grow exponentially too. Shares outstanding increased from 10.26 to 10.32 billion in the past 3 months. Recently they stopped repurchasing shares too and investing to grow the business. Hopefully in the upcoming years they will continue with their share buyback program. Their trailing 12 months free cash flow improved significantly from loss of 8.6 billion to gain of 3.2 billion, a 38% increase. And hopefully they will continue to move higher and higher. Next company in our portfolio is Meta Platform, which is one of the biggest advertisers in the world. They own a family of social medias consisting of Facebook, WhatsApp, Instagram, Messenger, and recently Threads, with an aggregate of 3 billion daily active users. They recently had a big swing in their share price, going from 384 to 88 in a year and going back up to 300 again in 9 months. There were a couple of reasons for this drop. The active users growth slowdown, advertisers spending less on marketing, and their plans to invest a lot of money into metaverse, which investors didn't like. But with a strategic pivot from management, the trust returned to the shareholders and the price started moving back up, unfortunately. I'm saying unfortunately because if the price was still lower, I would buy more and they would do share buybacks, and with the lower prices, they would be able to buy back 3 to 4 times more shares with the same amount of money. 3 months ago, they had 2.56 billion shares out, and now they have 2.57 billion shares. So they stopped buying back shares in the past 3 months, which is understandable. They bought a lot of shares when it was lower and stopped doing that when it went higher. I did the same thing. They are thinking like a shareholder, investing money where it makes more sense, back into the business instead of returning to the shareholders when their stock is high. Their trailing 12 months free cash flow increased from 17.57 billion to 24.03 billion in the past 3 months, which was a 36% increase in my income from Meta. The last company in our list is Alibaba, the leading online retailer in China with 1 billion active users and a fast-growing cloud business. They recently had some regulatory problems with Chinese government and at the same time a slowdown of the business, which caused the price to drop significantly, and it has not fully recovered yet. They are still very cheap, but they come with some risk like where they are located. Number of shares outstanding went from 2.56 to 2.55 billion in the past 3 months, which increased my ownership. Their trailing 12 months free cash flow increased from 25 to 27 billion, which will increase my income from Alibaba by 9%. In total, my ownership increased in most cases without me buying any new shares in the past 3 months, and my income from investment grew by 39%. Actually, I have not bought anything in 2023, and I'm just saving and waiting for the next great opportunity to present itself. The last thing I've bought was some Apple and Amazon on December 13th, 2022. That's it for our portfolio update. I hope now you have a better understanding understanding of why we buy good businesses that over time make more money than before. They may face bumps in the road, but they can manage to get out of them without facing big issues. Remember, investing is a marathon, not a sprint. It's all about making informed decisions and being patient. If you found this video helpful, don't forget to hit the like button, subscribe to the channel if you have not done so already, and share it with your fellow investors. Stay tuned for more updates, and as always, happy investing.